In terms of the equity market, it continues to rise with the anticipation that we're going to have a soft landing and with an anticipation that the Fed is going to cut rates. AAA buyers and big buyers of bonds to come back into the market and feel comfortable to buy bonds that they're not going to lose value the next day.
Thanks for joining. Today we have the very exciting guest speaker of Warren de Haan, who is CEO of ACORE Capital. They are a multi-billion-dollar lender, alternative lender in the commercial real estate space. And so he's here to join us, and we're going to talk about macro trends in the economy and then some specific questions that we have today from the Cornell Real Estate Council for the Dallas chapter. So Warren, thank you so much for joining.
Thank you, Ron. Thanks for having me. Happy to be here today with everybody. When I'm asked about this question about where we sort of stand and how to think about the issues, there is a lot to unpack. So I like to think about it in the context of the macro issues that we're facing today, the capital markets, the cost and availability of capital, and thirdly, the fundamentals. And the fundamentals being the demand side that drives real estate revenues at the property level. So we're going to share with you a couple of slides here that I put together. The first slide is really an illustration of what's bouncing around in my brain as I think about these complex issues, whether it's the issues associated with the Fed, liquidity, fundamentals, pending recession, soft landing, hard landing, inflation, interest rates, yield curves, the regional banking crisis or otherwise. So I figured an easier way to do this would to break this into the categories. And the first category is the macro environment. Within the macro environment, there are a few drivers and a few issues that we think about every day. The first of which has been this extremely high inflationary environment, which in the middle of 2022, we were north of 9% inflation. We all sat there, looked at this, and we knew it was going to be problematic, but we didn't really understand what the impacts of high inflation and hence high interest rates would be. It's clear that the Fed was slow to make the necessary adjustments. Coming out of 2008, 2009, and 10, where Fed policy was to reduce interest rates to zero, rebuild the banking sector, we appreciated a significant growth in our employment base and hence drove a significant asset bubble. It felt to many of us along the way that it was time for the Fed to moderate rates or increase rates at the time to slow the economy as we were all seeing these asset bubbles develop. What we were not really expecting from the Fed was the rapid increase in rates. It's not necessarily the order of magnitude of interest rates being around, the 10-year being around 4 to 5%. It was the speed with which rates increased that broke the system. And there were a number of areas that got broken. Most specific was the impact on the regional banking system. And so in the regional banking system, we saw what happened with Silicon Valley Bank, where Silicon Valley Bank was acquiring assets that were long-dated assets, safe assets, treasuries, so probability of default was really low. But from a mark-to-market perspective, as interest rates rose, there was significant losses associated with those mark-to-markets. Now, don't forget, in the banking system, what a bank is, when we deposit money, we're lending money to the bank. A lot of people actually forget that. And when we want the money back, we want it back instantly. So the idea of managing assets and liabilities in the banking system is closely regulated, particularly in the large Main Street banks. But the regional banks, when you talk to some of the experts, maybe operated with more flexibility. And therein lies a big part of this liquidity problem. So Fed increases rates rapidly by 500 basis points, and that causes significant mark-to-market issues. The regional banking sector, when one looks at commercial real estate, makes up about 70% of all bank loans in commercial real estate come out of the regional banks. It's not obvious to many of us when we think about borrowing from Bank of America, Wells Fargo, and the big money center banks. But 70% of all commercial real estate loans come out of the regional banking system. So a crisis, whether it's a liquidity crisis or otherwise in the regional banking system, has significant impact on liquidity all of our markets across the country. So what was born out of this particular issue is that the regional banks now face significantly higher regulatory framework. Last week was the Senate Banking Committee, a lot of back and forth, a lot of partisan lines were followed, unfortunately, so it makes it less interesting. But fundamentally, we are seeing an increase in the regulation of the regional banking system. But the issues don't stop there. The regional banks are also dealing with balance sheet related issues. So go back to 2009 and 10. In 2009 and 10, what happened is the Fed dropped rates to zero. That enabled the banks to rebuild their balance sheets because their assets were yielding 4%. I'm making up that number, but it's not far wrong. They were borrowing money at zero from the Fed window, so they had positive leverage and they were able to rebuild their balance sheets. The second thing that brought us out of 2009-10 was we had significant unemployment as a result of low cost of capital and plenty of capital available for the consumer and businesses. We were able to hire more people and effectively grow our economy. So today the issues we face are, yes, the Fed window is open, but the cost of borrowing is 5.5% for banks. And guess what? Their assets are yielding less than that. So that's negative leverage. So effectively, that doesn't grow their balance sheet, that will shrink their balance sheets. The other issue that the regional banks are facing, and this is from discussions with friends of mine that are CEOs of those banks, is with the rapid increase in interest rates, what happened is the banks were making fundamentally good loans. 55% loan to value, multifamily loan to a good developer. When they made the loan, it was a 1.3 debt service coverage, but with a 500 basis point increase in the short end of the curve, now that's a 90% loan to value loan and a 0.8 debt service coverage. That has to move from tier 1 capital to tier 3 or 4, meaning that the bank has to hold more capital against that loan. So there is limited amount of balance sheet capital at the right cost in order to help grow the bank's balance sheet. And that is proving to be a real problem. The other side of this is that the deposits, if you're going to deposit money in a bank, you are now, and treasury yields at 5.5%, risk-free rate, why would I deposit my money for anything less? So there's obviously liquidity in that too, but you're still going to demand a high deposit rate. And so that is the liability side of a bank's balance sheet. So their margins have been significantly shrunk. So there's a long way to go in the regional banking system. So fundamentally, given all of this going on, the takeaway is the banks are being more conservative. The banks are over-allocated to commercial real estate debt and therefore need to reduce their commercial real estate exposure. And they need to rebuild liquidity. And that liquidity can then be used to make new loans, not necessarily to commercial real estate borrowers, but to others. So therein lies, part of this giant issue. The other issue on the macroeconomy that I think is really important for us to note in commercial real estate is the supply of capital versus the demand for commercial real estate debt. And when I say there's lack of liquidity, I'm not referring to equity liquidity wanting a 20% rate of return. I'm referring to debt, lack of cheap and available debt to stimulate the equity and for equity folks to get their rates of return. That's where the problem lies. We have about $2.5 trillion of debt coming due over the next 5 years. There's about $4.5 trillion of debt outstanding. You've got about $500 billion of private equity sitting on the sideline looking to acquire assets at a 20% yield. So the need for commercial real estate debt is approximately $3 trillion over the next 5 years. The supply side is the banks. We talked about the banks traditionally have been the largest sector they're in. There's the non-bank lenders like ACORE, and we're still a small part of the ecosystem. There's the insurance companies, and then there's the CMBS markets. What's happening is that the banks are pulling back, looking to reduce their exposure. The non-bank lenders like ourselves are growing significantly. Insurance companies are still active, right? But generally speaking, lower leverage. And the CMBS marketplace has been problematic, meaning that because of rate instability, or the fact that there's been an increase in rates, the big bond buyers have been hesitant about coming back into the market until recently we're seeing more rate stability. So in order for those loans sitting on the bank's balance sheets to get cleared out, we need an actively operating CMBS marketplace at a good price, which is driven really by AAA buyers and big buyers of bonds to come back into the market and feel comfortable to buy bonds that they're not going to lose value the next day. So rate stability is an incredibly important aspect. There are other macros that are obviously of interest here, clearly the Fed and the yield curve. So I'll touch on the yield curve quickly. Interestingly, the bond market is exponentially larger than the equities market. And what we have seen in the equity market is that there is a lot of optimism. And a lot of optimism is really driven by corporate earnings having been fairly good, although a lot of the growth in the S&P and otherwise has been driven by the large tech companies. But in terms of the equity market, it continues to rise with the anticipation that we're going to have a soft landing and with an anticipation that the Fed is going to cut rates. About 6 months ago, there was a disconnect between where the bond market was thinking things were going versus the equity market. But what we're starting to see is a convergence of the optimism in the bond market with the equity market, which is very interesting. So if you look at the forward SOFR curve as an example, it looks like we're going to be entering a 3.5% interest rate on SOFR in the not too distant future. And that's the bond market's perception of where things are going. So there's a lot of data points that go into that. The 10-year Treasury, similarly, we've seen the 10-year Treasury come down from around 5% down into the low 4s with a landing point of in the high 3s and then gradually increasing over time. So there actually is quite a lot of optimism reflected in the forward yield curve. We also deal with some other larger macro issues like geopolitics, the giant $33 trillion budget deficit at the government level, but these are ideas that are probably for another discussion. I will touch on two other things that I would just highlight that I think people should focus on are the words secular versus cyclical. And secular being changes that have happened over a longer period of time that are more longer lasting. So in that regard, it's the secular change in demand in the office sector, the way people consume the product. We've seen that in retail, but we've seen some stabilization in those patterns that are more underwritable, creating more interesting opportunity, I would say, in retail. And then as it relates to cyclical issues, I think one needs to look at things like oversupply in multifamily and in certain other sectors that are creating cyclical issues, not secular issues. But for purpose of being intellectually honest about them, I would encourage you to separate the two to identify the risks. So I'll move on to my next slide then, which is the capital markets slide. So what does it mean, capital markets? Capital markets is really trying to identify the cost and the availability of debt capital. Secondly, we look at risk premiums. There was a very interesting article in the Wall Street Journal about 4 weeks ago that referenced the 30-year residential mortgage. Don't forget, a mortgage is made up of a base index plus the risk premium, the spread. In the risk premium, the spread, it's the profit to the dealer plus the perceived risk, the embedded risk that an investor wants to take that, return that investor wants to take that specific risk. Now, if you look at the 30-year bond or the 30-year mortgage, mainstay of the US housing market, traditionally, the spread over the 30-year Treasury has been about 160 basis points. At the time of printing that article, it was about 280, meaning that buyers of those bonds are perceiving incremental risk in the product and therefore requiring an increased spread. It's very interesting, right? So what we have seen with this instability and this potential hard landing is any products like this are requiring a higher risk premium. So when you look at your loan today, whether it's a residential loan or a commercial loan, it's made up of a base index, which is 500 basis points higher than what it was, several months ago, plus risk premiums that are wider, resulting in very expensive debt markets today. So for now, your cost and your availability of debt capital is constricted, resulting in higher cost of debt. Obviously, higher cost of debt means wider cap rates. And we talked about the risk premiums. My perception, this is my perception, and there's many different opinions, is that we're going to be in a higher rate environment for a longer period of time, lower than where we are today, but for a longer period of time, higher than what we've seen over the last several years. Or should we say a more normalized higher interest rate environment, which is going to result in a repricing of assets, commercial real estate assets, in the aggregate. Obviously, some assets are more powerful than the others, they've got better fundamentals than others, and they'll get repriced differently. The latest Green Street data, I think, is somewhere in the private markets, a repricing of somewhere around 20% in the aggregate, with obviously office, taking the brunt of that, and then asset types like data centers and others outperforming on a relative basis. So my view prospectively is a resetting in valuations, a higher but not absurd cost of capital going forward, a repricing and a reset in the commercial real estate industry that we need, combined with rate stability to create more liquidity going forward. But I'm not anticipating rates to scream back to where they were, and I'm not anticipating that cap rates will go back to where they were. So that is the capital markets view. The third slide addresses fundamentals. The definition of fundamentals is what drives revenue at the real estate level. So I break that into three categories. It's the health of the consumer, it's corporate spending, and thirdly, it's the impact of government-stimulated demand. The government-stimulated demand, I'll start there. There's about $7 trillion that is being approved by Congress for spending on government programs, whether it's the CHIPS Act, the Recovery Act, or the Infrastructure Act, among several. About $2.5 trillion has been spent, or is in the economy so far, and measurable, and there's several $1 trillion still to come. I think that this particular category of demand is generating some false positives in the economy, meaning in construction, for example. I would have concluded by now that the cost of construction should have come down further than it has. But when I talk to my head of construction, she says, no, Warren, that's not the case. These subs are going from one project, building housing, to working on infrastructure. So this is what's holding the employment numbers very strong. So unemployment being very low, and secondly, wage growth. And for us in the commercial real estate space, in development, when you're looking at a project and thinking that the costs are coming down, the cost of labor is actually pretty sticky. And this is the reason. Corporate spending, generally speaking, corporate earnings have been pretty good. Commercial real estate, debt in the corporate context has got better term on it than a lot of the commercial real estate debt, longer dated they've been termed out, fixed rate, and generally speaking, lower leverage. So there's not quite the same issue that exists in corporates versus commercial real estate. The final point makes up a very large part of GDP, which is consumer spending. So this is the point that if you're going to study anything, stay focused on the consumer. Pre-pandemic, the average household in the United States had $400 in savings. After the stimulus, during COVID, it was $2,400. So the average American family felt actually quite wealthy. Also, very low interest rate environment, right? So that was helpful, they were spending. Based on a couple of reports that I've read recently, it feels like the consumer is approaching that $400 level again. So 400, 2,400, back to 400. Some other challenging data. We are at an all-time high of delinquencies or default rates for subprime auto loans. Think about that for a moment. Autos, in my opinion, is kind of the last thing to go. If you're out of money, you don't want to let your car go because one, it brings you freedom and happiness, and two, is it gets you to your place of work. So for you to relinquish that sort of last frontier it'll take you a lot to get there. So that is challenging. It also probably tells you something about the distribution of wealth in the United States, meaning that the lower income folks are being disproportionately penalized by higher inflation versus high income earners. But that's for another debate or discussion. The second statistic that I think is interesting is to look at credit card debt. I think we're at a 20-year high on average household credit card debt, which means the consumer is spending, but they are borrowing more money. And what we do know on the positive side is we're also at historical high net worth driven by household values, because there's not a lot of homes selling, right? So the implied value in homes is still very, very high. I think the number was somewhere around $25 trillion. And we have very strong employment statistics, both from an employment perspective, but also wage growth. So what is going to happen to the consumer? I think we can all think about that on our own. From my opinion is that through the first half, at least, of 2024, we're going to start identifying some cracks in the consumer. That's going to trickle through to consumption, it's going to trickle through to GDP, and it's going to trickle through to commercial real estate. So depending on what you own and the direct impact, it's going to be vary. So for example, if you own the Four Seasons Hotel, in Surfside, Miami, the demand is inelastic, and so the demand won't change as a result of an increase in price. But certainly if you're at the low end of the spectrum and the consumer at that level has been struggling, you change the price, demand is going to be elastic, and that's going to impact the value of your fundamentals. Multifamily, very interesting sector, cyclical issues with new supply, strong consumer, strong liquidity in the government agencies. We're short 7 million housing units, and the cost to buy a new home is prohibitive. So the demand side of the fundamentals in multifamily remains extremely strong. The issues and the weakness we're starting to see is really around it being a good business, but with a capital structure that is impaired. And the capital structure is impaired because between 2021 and 2023, a large volume of multifamily buildings were bought at cap rates that were reflective of very low interest rate environment. Those acquirers would not have bought those apartment buildings at 3 or 4 caps if they thought that interest rates were going to spike the way they did. That was 2 years ago. Fast forward to today, we're going to see a lot of interest rate caps expire, and we're going to see a lot of stress in the multifamily sector, not because they're bad buildings or the fundamentals are bad, it's because they've got capital structures that are prohibitive today. But by and large, in commercial real estate, we're seeing good fundamentals. I'm just pointing through the 3 giant categories that could mitigate or change those outcomes in terms of fundamentals. And with that, I'll pause.
Yeah. Well, thank you very much, Warren. I think that was a great conversation that really, touched on that balance, that combination of factors.